we're going to begin Chapter 4. Chapter 4, as you can see, is going to deal with the completion of the accounting cycle. So far, we've gone through several components of the cycle, and this will complete the accounting cycle from the bookkeeping perspective. The first learning objective of the first module regarding the completion of the accounting cycle is the preparation of the financial statements, as well as we're going to spend some time on focusing on this classified balance sheet. Now, the classified balance sheet and the other financial statements are going to be prepared from the adjusted trial balance. Preparing financial statements from the adjusted trial balance takes place after posting all of the adjusting entries to the general ledger, and of course the balances will be updated at that point. You know, as we mentioned toward the end of our previous modules, we will be using a worksheet, and that worksheet will allow us to examine the effects of the adjustments on the financial statements. Now, after we post them, the adjusting entries will actually be made in the journal ledger or the general ledger accounts. So the way it's going to work, and let's think about the adjusted trial balance now, preparing that, and then of course from the adjusted trial balance, you're going to see that the financial statements will be prepared. And let me see if we can sort of outline where we went with this and how this is going to, take a look at the effects on the accounting cycle. So we know that we're going to journalize these adjusting entries. And if you remember, these adjusting entries will affect accruals and deferrals. As we also said, the adjusting entries will not involve any cash. And then we post to the general ledger. Then from the general ledger accounts, we'll do the adjusted trial balance. And then from there, the financial statements. Okay, so now an important thing to remember is that no account on the adjusted trial balance, of course, will be used more than once. Each account will be used on one financial statement. So, I think at this point you should understand that service revenue will be on the income statement, but it would not appear on any other statement. Now, let's take a look at a sample of an adjusted trial balance. This adjusted trial balance is once again going to be part of our sample company, Smart Touch, and we're working with the adjusted trial balance after making the adjustments for accounts such as the depreciation expense, in the accumulated depreciation account, the office supplies account. If you remember, that account was adjusted from its previous balance. Let's just think about what had happened. We purchased, if you recall, going back to our original example, we purchased supplies, and those supplies were $500 in total. Now we're coming to the adjustment process, and what we found out is when we went into the warehouse, we counted the supplies, and we found out that the supplies only had a balance of 100, so that we started with the 500 just again to refresh your memory, and that means we must have used up 400, and that's when we come here and charge the income statement for the supplies expense. So when we prepare the financial statements, realize, of course, that office supplies will be moved to the balance sheet, so that the balance sheet will now reflect the correct balance of office supplies, and office supplies expense is going to be on the income statement. Now, of course, we have to remember that, the statements do articulate, and the impact of the expenses will wind up affecting equity through retained earnings. So this idea, again, of articulation and the sequencing of the preparation of financial statements still applies when we use the adjusted trial balance. I know we looked at this earlier in a previous chapter. So the concept of articulation, the interaction and the relationship among the financial statements still applies when we're using the adjusted trial balance. So again, I think this is a good review. We're going to see, of course, that the income statement is going to be prepared first, and then we know that the income for the year is going to help us prepare the statement of retained earnings. So let's do that first for Smart Touch Learning. And again, the numbers are the same, but it's always good to review them. When we take a look at the income statement, which is the yellow shaded area, as you can see, revenues minus expenses will go on the income statement. So once again, just to review, the format is the name of the company, the title of the statement, which of course is the income statement, could also be called the statement of profit and loss. And then notice it's for a period of time. It's a flow statement. So it's only for the 2 months ended December 31st of 2014. And we simply move the adjusted accounts from the trial balance into the financial statements. So the amounts from the income statement will move into the financial statements. And you always prepare the income statement first. You notice that we have separate accounts for different types of plant assets when they're depreciated. So that's something to keep in mind. Notice also, again, just by way of review, that we list expenses in order of magnitude, unless you're told that certain expenses may be more critical to the company's well-being. And in this case, that's probably what happened, because perhaps Smart Touch needs to rent, let's say, retail outlets or storefront properties, and therefore their rent is a critical part of their business. And then, of course, salaries comes next. So typically we list in the order of magnitude, but in this case, by listing rent expense first, it is done to highlight the importance of that particular expense. Now, when we think about the articulation, the next thing we need to do is to move net income for the year into the statement of retained earnings. And of course, we know that the change in retained earnings will be based off of two issues or two transactions. One would be all of the transactions that affect net income, and the second is the dividends. So the information from the statement of retained earnings will have to come from two places. Those two places are, of course, the income statement for the income for the year, and then, of course, the dividends will come from the trial balance. So again, the two events that impact retained earnings are net income or net loss for the period and any dividends declared. And by the way, that is an important term. The declaration of the dividend is what makes the dividend a legal liability. That declaration means that the board of directors declare the dividend. It's a legal liability of the corporation, and it is not necessarily going to be paid at that point. So once the liability is created, it doesn't mean you have to pay it. So dividends do not necessarily have to be in cash. So in this case, when we now think about articulation, we know that the net income for the year is $85.50, and of course in this example we don't have a beginning retained earnings, so we move the net income for the year into the statement of retained earnings. Again, company name, also a flow statement for the 2 months ended. And as we said, for our textbook purposes, we're going to be using a simple statement of retained earnings, but typically corporations will be preparing and reporting and issuing to shareholders in the SEC a much larger statement of changes in stockholders' equity. Then, of course, the dividends are going to come from the trial balance. Net income minus dividends is the change in retained earnings. In this case, the change also is the balance. Now, of course, we said that retained earnings is a balance sheet account. Balance sheet accounts are cumulative. They are permanent. They are incomplete cycles. They carry over period after period. So remember, the ending balance of November is the beginning balance of December. The ending balance of December is the beginning balance of the next period. Okay. Beginning balance of the next period. And this simply highlights the articulation, the movement of the ending, or I should say, of the net income into the statement of retained earnings. Now, as I said, the net income for the year has to be derived first, and that is coming again from the adjusted trial balance. Now, in this case, there was no beginning retained earnings because it was the first year of operations, but remember that the ending retained earnings will be used again in the balance sheet. So in order to make the balance sheet balance, once again, focusing on articulation, the ending retained earnings that comes from the statement of retained earnings must be used in the balance sheet. And we see that here in the financial statement. So once again, net income minus dividends gives us the ending balance of retained earnings. And what we need to do, of course, is to focus on this number, because this number is needed to make the balance sheet balance. And of course, here, when you go back to the adjusted trial balance, notice that in stockholders' equity right now, we've got contributed capital or common stock. We don't have any retained earnings here because there was no beginning balance. Please note that these are very simple illustrations, and then going forward, the next adjusted trial balance will in fact have the retained earnings of $35.50 as the opening balance, and that has to, of course, be adjusted. Now, the balance sheet, of course, will be, as I said, prepared from the statement of retained earnings. So the sequence, again, is the income statement, and then the statement of retained earnings, and then the balance sheet. The balance sheet presented in our illustration is going to be unclassified. That means we're not going to classify the assets as current or non-current. We're not going to classify the liabilities as current or non-current. And of course, we're going to use what is known as a report form. There's also something known as an account form. A report form, incidentally, will list assets above. So total assets will be listed above the liabilities and then stockholders' equity. That's the report form. There's also an account form of a balance sheet, which we'll see at some point. And it looks like a T account. It puts the assets on one side, just the balance sheet, and liabilities and stockholders' equity on the other. It's really in debit and credit format. Assets go on the debit side, liabilities and stockholders' equity go on the credit side. And by the way, don't forget that assets do have contra accounts, so accumulated depreciation would in fact be included on that asset side of the balance sheet. Now, the transfer of any retained earnings will, as we'll see on the balance sheet below, is coming from a statement of retained earnings. And as I said before, this is a key point that the retained earnings account, let me go back down for a second, the retained earnings is not correct because it didn't use the net income for the year and didn't have dividends. So what we see on that adjusted trial balance is zero in this case. The adjusted trial balance only includes last year's balance or the beginning balance of this year. And of course, that was zero. Moving to the balance sheet now, we would have to, again, take the balance sheet account. So as you can see, these items highlighted in yellow, these are all my balance sheet accounts. What I have to make sure we include are the equity, and of course the equity is coming from two places. Common stock or contributed capital comes from the adjusted trial balance, and you see the yellow highlight here. that retained earnings is coming from the statement of retained earnings. Now, this is an unclassified balance sheet, and once again, let's look at the heading, name of the company, balance sheet, and it's at. It's a position or a point statement. It is not for the period ended. It is only at a particular point in time. Also notice, as I said, the credit balance contra accounts will go on the asset side of the balance sheet. The report form, unclassified assets listed first, total assets 113,550, and that's listed above the liabilities and stockholders' equity. And incidentally, of course, you have to have your ending balance of total liabilities and stockholders' equity equal to your total assets. And again, just like the accounting equation, remember the balance sheet is in accounting equation format. So the 113,550 is equal to liabilities of 62,000, which is your total liabilities, and your stockholders' equity 113,550. Okay, so I'm sorry, the total stockholders' equity should be 51,550 with the total liabilities and stockholders' equity at 113,550. Right. So again, it's in accounting equation format. Liabilities 62 and stockholders' equity 51,550. Again, just to emphasize, if we take a look at the green arrow, it is going to be moving the ending retained earnings. Sorry about that. We're going to be moving the ending retained earnings to the stockholders' equity section of the balance sheet. Now, as we said, this is an unclassified balance sheet in report form. So it's unclassified and it's report form. Now, moving to the classification, classifications are important, as we'll see in a moment, but the refinement here is to classify assets and liabilities by time of usage or when they're due. It's more useful for financial statement users, and as we know, that in order to be useful, it's got to be relevant and representationally faithful. And to be useful here, we're making the information much more relevant by classifying it for the user. And of course, financial statement users may be able to classify based on assumptions, but to be precise, you would need the firm or the entity that is reporting the information to come up with these classifications. The idea is to allow the user to match maturities. And the notion of matching maturities means that you want to be sure that when debt is coming due, when liabilities are coming due, you have sufficient assets that would be liquid, converted into cash in order to pay off these liabilities. And again, this is going to be part of our cash operating cycle. So on a classified balance sheet, we generally classify assets, liabilities as current or non-current. And first, let me define what we mean by a current asset. So let me see if I can get over to the whiteboard for you. So when we define a current asset, current asset will be used or consumed within 1 year or operating cycle whichever is longer. Now for us, typically it's 1 year, but there are some industries that have an operating cycle greater than 1 year. Now, what's an operating cycle? Well, an operating cycle, for example, for a business that might be dealing with retail, you would start with cash and you would buy inventory. To sell, goods to sell. You may not have enough cash, so that may require that you use trade credit to buy the inventory. Then the inventory is sold. That inventory, when it's sold, is not always for cash. So we have an accounts receivable, and that has to be collected. So we're back to cash again. Usually, that cash will be used to pay off liabilities first. You could make investments. We'll get back to that later. But once liabilities are paid off, you put the cash back into the operating cycle. Now, this cash-to-cash cycle usually occurs several times in 1 year. Usually you would have cash to cash 2-3 times depending on the industry, but there are some businesses where it takes more than a year to complete the cycle. So manufacturers of, let's say, corporate jets like Gulfstream or Bombardier jets, that may take more than a year to build. Boeing, large corporations, shipbuilding, as I always say, anything that's not good for you, for example, alcohol and tobacco, has to be aged. It takes more than a year sometimes to use the inventory. In fact, I was reading the financial statements of a tobacco manufacturer, and they said, we have leaf tobacco in inventory that we will not be using for 18 months, but our operating cycle, of course, is more than a year, and as a result, that is still a current asset. So by definition, the current asset will be used or consumed within 1 year operating cycle. Typically for us, 1 year is going to be fine. Now, current liabilities can be defined similarly. Current liabilities are due within 1 year or operating cycle. And of course, whichever is longer. Okay. Or another way to look at this, which I think is much more precise, it will use current assets or create other current liabilities in their liquidation, in their payment. Sometimes called liquidation of liabilities. So current liabilities will be paid from current assets, or you create other current liabilities. So going back now to the classification, what we're trying to do here is match maturities. So if a user or a financial analyst is looking at this balance sheet, they'll see the number or the dollar amount of current assets that are expected to come due, that are expected to be converted into cash, sold or consumed within 1 year of the operating cycle, or 1 year or an operating cycle, whichever is longer. So you expect to get cash in here, and that cash will be used to liquidate or pay off those current liabilities. On the other hand, if the liabilities are, or the assets And these are long-term assets or non-current assets. These assets will not be used or converted into cash within 1 year or operating cycle. Sometimes these are called non-current assets. As well. And that would be long-term investments in, let's say, stock of other companies or shares of stocks of other companies, property, plant, and equipment that would use land, intangible assets, as we said, could be patents, copyrights, goodwill. And all of those will not be converted into cash. They will not be used or consumed within 1 year operating cycle, whichever is longer. But that's okay if these liabilities are not due and payable within a year. So you're trying to, as I said, match maturities. When are the liabilities due? Do we have sufficient assets that would be converted into cash within that due date or within that time period? When are the long-term liabilities due? Do we have enough cash for the payment of that long-term debt? Now, as we also said earlier, that assets are listed in the order of liquidity. And I said that liquidity is the ability to convert into cash with minimal risk of loss. And once again, here is our current asset definition: cash and other economic resources that are reasonably expected to be realized in cash, sold, or consumed within 1 year of the balance sheet date or operating cycle, whichever is longer. As we said, companies like shipbuilding, tobacco production, distilling of liquor, maybe even construction, long-term construction projects would have an operating cycle greater than 1 year. We're going to go over this a couple of times. We'll keep taking a look at the conversion or the cash conversion cycle. So current assets, as you would expect, would include cash, receivables, supplies, inventory, and prepaid expenses. Not all of those are very liquid. I mean, if you think about it for a minute, if you have prepaid rent, it's not easy to liquidate those. It's much easier to liquidate. Of course, cash is already liquid. Accounts receivable could be liquidated, supplies, then inventory. So this is the order of liquidity. And we said that the cash conversion cycle is the cash operating cycle. Now, as I already mentioned to you, this is the cash operating cycle or the cash conversion cycle. And as we said, you got to buy some inventory, use cash, accounts payable. I'm going to bring the securities in right now. These are trade accounts. That inventory sold. You collect the receivables and convert them back into cash. When that cash comes in, the first thing you're going to do is pay off your trade payables. Secondly, if you have excess cash, you're going to put that excess cash to work. So you might invest in a CD. You might put that into any other type of interest earning asset. Hold that until the cash is needed. So you would sell these securities if cash is needed in the operating cycle. And then finally, third, you would put the cash back into the business. Okay? So this is the cash operating cycle. Long-term assets, sometimes, as we said, non-current assets, include long-term investments. These are, again, resources such as investments in a company's stock that we don't expect to be realized in cash within a year operating cycle, whichever is longer. Same thing with tangible plant assets, non-current assets such as land and buildings. We don't expect to, first of all, to sell them in a short period of time. And we do know, of course, as we said earlier, that your non-current assets are, of course, going to be any assets that are not expected to be converted into cash. sold or consumed within 1 year of the balance sheet date. We also have intangibles, and we already mentioned that intangibles could include goodwill. We talked about this a little bit, but these again are non-current. Typically, they don't have physical substance, but they have value. They have value. Although there's no physical substance here, the value, the asset value of an intangible results from the rights that they confer on the holder or the owner or holder of that intangible. So patents, copyrights, what about a franchise? You got a McDonald's franchise, gives you the right to sell the burgers, fries, and all other McDonald's products. You have a piece of paper, maybe you had to spend, $100,000 to buy this franchise. McDonald's sets up the store for you, but you are going to be buying the McDonald's product, but you have the right to sell that product. That right, that franchise is an intangible asset. All right, so now, if you look at a classified balance sheet in the account form, here's the way it looks. These should be, again, stacked. Assets first on top of liabilities and equity. But notice the difference between this and the unclassified. This is classified. So notice the difference between this version of the balance sheet is that we list the current assets. Again, it's the order of liquidity. Most liquid first. By the way, this is decreasing order of liquidity. In international statements, you could have them as increasing order of liquidity. In other words, start with the least liquid. But of these assets, of course, cash is the most liquid. And then you have your receivables that could be sold, supplies, prepaid rent. Again, it's not easy to sublease. If you gave a landlord 3 months rent and you want to sublease that, it's not very easy to do. So the same thing is true here for your non-current assets, and these are your non-current assets. And these would be furniture minus accumulated depreciation. Notice the contra account here. Same with building minus the accumulated depreciation. On the liability side, it's the same thing. The current liabilities in order of maturity, and you have long-term liabilities here. And once again, we're trying to match maturity. So for example, this company has 16,100 of current assets that are available to pay off 2,000 of current liabilities. So this company seems to be, Smart Touch seems to be pretty liquid. Doesn't seem to have too many problems paying off their current debt. They've got cash of 12,200. They got receivables. So the company is in a very strong liquidity position, holding all other information constant. And again, the assets are divided, as we said, into current and non-current. There could be sometimes a separate section for investments. Also on the classified balance sheet, as we said, we have our current liabilities, and they're listed in order of maturity so that they are paid first. So the shorter maturities come first. Those are the current, then the longer maturities on the long-term debt. Now, current liabilities, as I defined earlier on the whiteboard, are obligations that are reasonably expected to be paid out of current assets or creating current liabilities, whichever is longer. We know that they are due and payable within 1 year operating cycle, again, whichever is longer. When we think about obligations that are due beyond 1 year operating cycle, these are long-term, and of course, these will not be paid out of current assets or result in the creation of other liabilities, typically. It is interesting, of course, that the current portion of long-term debt is classified as a current liability. So one thing you should know, if we go back to the whiteboard, if you are looking at the liability section of the balance sheet, and you have current liabilities, and we have long-term liabilities. Let's say you have a loan of $10,000. $1,000 is paid each year. On the balance sheet, you must classify that debt properly. In other words, that debt must be reflected as being due within 1 year or due in a period greater than 1 year. So if I had to, I could have note or loan payable. If I had to prepare a balance sheet at the end of this year, only $9,000 is long term, because part of that note is due next year, or operating cycle, whichever is longer, but in this case it's going to be each year. And that's $1,000. So the $10,000 debt is split between current, because that's going to use up current resources, current assets, and long-term liabilities. Because again, they will not use up current assets. So again, that has to be properly classified, and the current portion of long-term debt is a current liability. Now, finally on the balance sheet, stockholders' equity. And the stockholders' equity section is really specific to corporations. The owner's equity section will depend on the legal form of business. And as we said in our first chapter, there are 3 forms of business: a sole proprietor, a partnership, and a corporation. In a proprietorship and a partnership, the capital accounts are listed in the name of the individual. So it's the owner's name, comma, and capital. Unlike a corporation, where the owner's equity is called stockholders' equity, and it is divided into 2 main sections: contributed capital, that's amounts paid in by stockholders. That would, of course, be the amounts that are contributed by the owners or invested in the business. Right now, that's common stock. And there is earned or earned capital, and that's part of retained earnings. And again, you could have more than one class of stock. I think we mentioned that. You've got common shares. They have less rights or priorities. They have the right to dividends, but you have preferred shares. And preferred shares generally is a senior equity. It has seniority over common, particularly with dividends. So if the company only has $1,000 and the preferred dividends are $800, the preferred shareholders have the right to get those dividends first, and then anything left over goes to common. Common is sometimes called the residual equity. Now, on the classified balance sheet, we know that, of course, liabilities are listed in the order of maturity. So the current maturities come first. Those are your current liabilities, and your long-term liabilities are second. And then, of course, your stockholders' equity is made up of both your common stock, that's contributed capital, and retained earnings. So again, here, common stock is part of what we call contributed capital. And then, of course, retained earnings, contributed capital, and retained earnings. So if you wanted a good summary of that classified balance sheet, this last slide will provide you with a very, very good summary of the classified balance sheet. It takes you through each classification, and it will provide you with a much greater detail than we've covered, but this will be good as a guideline as we go through the course. And finally, going back to the document camera, we're going to be moving into learning objective 2, and here we're going to be using a worksheet. And so far, the worksheet only has taken us through the adjusted trial balance, and we're going to repeat that. But I just want you to be sure to understand, and again, you know that from here, we prepare the financial statements. And what I want you to know is that the worksheet is not a financial statement, just to be sure. It's a tool, and it's not a financial statement. Right, so we will see this in our next learning objective.